Hello guys, welcome to Bhavna's Online Academy. So in this video, we are going to learn AS13, that is your accounting for investments. So in this lecture, we are going to cover both the concepts and as well as the sums for AS13. So now let's begin with the video guys. So accounting for investments. So in this AS, what are we going to learn? We are first going to learn what is included in investment or what do we call as investments, and then how are we going to record or recognize it in our books. So the accounting part also we are going to learn here. Okay. So investments, as you all know, is shown in the, if you see a balance sheet, on the asset side, your investments are shown, right? So what is asset? Oh, so what is investment? Investment is one of your assets. Okay. So assets are held by the enterprise first. So what kind of assets do investments cover inside them? So any asset which will help you in earning income. Earning income means any asset using which you will get income in the future or in the present, you can call them as investments. Example, what kind of incomes can you earn from these assets? They have told in the standard that there are three incomes. One is your dividend, then you have interest and your rentals. If these three kind of incomes you earn from any kind of asset, then those assets will be classified as investments. Okay. So what do you earn dividend from? Your shares. So shares will come under your investments. What do you earn your interest from? You can earn your interest from bonds. So bonds will also come under investments. Then finally rentals. From where can you earn rent? That you will earn from your property that you have. So property is also included under investments. So few examples for investments are your shares, bonds, debentures. From shares you get dividend, bonds and debentures you get interest. From your FD also you'll get interest. Then you have FD means your fixed deposits. Then you have your building, land. From all of these you can earn your rentals. Okay. So these are the examples for investment. Okay. So first these from whatever assets you earn income, that will come under your investments. The second form of assets which will come under investments is from the assets from which you can get capital appreciation. Suppose today you buy a land for 1 crore rupees and after 5 years if the land value is going to rise up to 2 crore rupees, that means this asset has appreciated in its value, that is capital appreciation has happened. So such land can also be counted as your investment. Okay. And finally the third form of asset which is considered as investment is either benefits to the investing enterprise. That means any other benefits if you get from that asset, you can call them as your investments. The third point you need not see for now. For now, our scope will be limited to earning income and capital appreciation. Okay. Yes. So here I have given you example. We'll first see that if you see in the case of shares, from shares you can earn your dividend. Correct. And also if the share value increases, you will get a capital appreciation from it. So shares will get included in AS13. Next, you have your bonds or debentures, we can say. So from that you earn interest, as well as if the value of bond increases, when you sell it, you will get capital appreciation. That means you'll get a higher value for it. So capital appreciation, that is also included in AS13. Next, you have your property. Now here you have to see, if there is a property which you have given on rent and from that you get some money, such asset will be classified as investment. So from a property, if you get rent, that will come under AS13. If a property is being capitally appraised or capital appreciation is happening on a property, that will also come under AS13. Now, but what about a property? Example, if you have a property which you have got for residential purpose, that residential purpose means you are planning to go and live there. You have not got it for your business. So it is just for a residential purpose and neither you are going to give it on rent or anything. Okay. So such property will not come under the scope of AS13. There are three reasons for it. One, this is not for business purpose. So it cannot actually come in your business book itself. But still, you will not go earn rent from it, and also the capital appreciation you will not see here. Okay. Next, if you are getting a property for business purpose, but this property which you have got for business purpose, it is for your own use or for the business use. Suppose a jewelry shop. Okay. So they have a lot of jewelry shops in and around the city, and what they have is they have a building where they do their administrative or finance work. Okay, administrative or finance work. For doing those kinds of work, they have taken a different separate building on building, and they have purchased it, and that building, now you have to tell whether this building will come under the definition of investments or not, or whether such property will come under the definition of investments or not. The answer is no. This will not come under the definition of property. This will directly go under AS10 PP, because one, from this we are not earning rent, nor we have kept this building for its capital appreciation. We have taken this building only for the purpose of using it. So if you have not, if your asset basically does not give you returns in these three forms, or if you have not kept it for the purpose of capital appreciation, then in such case it will not come under AS13. Okay, yes. So next, there is one important point that you have to remember is that assets which are held as stock in trade. That means there is a asset, but what you have done is that asset now you are going to sell it out. Okay, example, now here you can take your example as inventory. Inventory is also an asset only, correct? We show it in the asset side of balance sheet, but it is held as stock in trade. That means you have kept it as for a purpose of selling it, correct? So such inventory will not, or such asset will not come under the definition of investments. Okay. So I hope the scope or what investments mean you have understood it properly. Okay. So there are a few other exclusions that the standards tell you that will not come under AS13. Okay. So the income that we earn from these assets, let it be your dividend, or let it be your rent, or another one interest. We read this three, dividend, rent and interest. These three, how you are going to recognize? That basis of recognition of these three income you are not going to read here. Only about the income generating asset. To generate this incomes, you will have asset, no? About that assets recognition only we are going to learn in this standard, and not about the income that we are going to earn from it. Okay. Next is, if you have invested in any retirement plan or life insurance policies, those kind of investments will also not be covered under AS13. That also will not be covered under AS13. Next, mutual funds and your venture capital will also not get covered under AS13. So these are the three exclusions which you have to remember. Okay. So now that we have seen what is covered under the scope of investments, or what does investments mean, now let's move on to seeing the types of investments. So there are two types of investment. One is your current investment, and you have your long-term investment. A simple definition that we know for current and long term is that any investment which is held for at least 12 months or less than that will come under current investment, and any investment which is going to be held for more than 12 months will come under long term investment. Okay. So here if you see the definition of long term investments, here they have told other than current investments, any investment which does not fall under the criteria of current investment will automatically go into long term, or will automatically be classified as your long term investment. Okay. So it means for more than 12 months, if you are holding anything, it will come under long term investment, but still we'll see what comes under current investment. If it is not being covered there, then we'll move it to here. Okay. So current investments. So in current investments, there are two criteria which you have to fulfill to call it as your current investment. First is it should be readily realizable. What does readily realizable means? It means that if today you are planning to sell that investments, or in the near future or within 12 months, if you are planning to sell out that investment, why do you classify something as current? You classify something as current because in that particular period of 1 year or less than that, you are either going to dispose it off or sell it off, correct? So for disposing it off or selling it off, you would need an active market for it. You would need an active market for it. What does active market for it means? For any product or for any investment that you're going to sell out, you need a few buyers who are ready to accept this, Suppose if there is a share, and what has happened is this shares which you have of a particular company, it is completely going in loss. Suppose we have Kingfisher shares. Okay. Now we want to classify this Kingfisher shares as our current investment, and for that we are looking at the criteria, and we see a criteria called as readily realizable there. Now here you have to see whether this Kingfisher shares, will you be able to sell it whenever you want to within this 1 year period of time? The answer is no. There will be no buyer for it, or nobody would want to get that share from us. So that means this does not have an active market. That means this is not readily realizable. So readily realizable means any investment which, if you want to sell in the market, has an active market for it. Okay. Yes. Second one is you do not have the intention to hold it for more than 1 year. So if you do not have the intention to hold it more than 12 months, then in such case, you can classify it as current investment. Now here there is one catch which is there. Okay, so now what is it is, you have an investment and what you did was you classified it as a current investment. Why did you classify it as a current investment? Was one, it was readily realizable. Second thing was, you had an intention that within this 1 year itself you are going to sell out this investment, or you are not going to hold it more than 1 year. But what happened was that such instances or such situations happened during the year that you were not able to sell out this investment at all. Okay. But what we thought that we would sell out within this year, but due to a few instances, we were not able to sell it. Now you have to tell me whether this investment which you classified as current in the start because you thought you would sell out in the particular period itself, was it right or wrong now? Here, you have to remember that in the criteria, they only say that you need to have an intention, that you will not hold it more than 1 year. If the intention is there, then that is more than enough. Therefore, this classification was right only. So, if you have an intention that you do not want to hold it for more than 1 year, then that is fine. You can classify it under current investments itself. Hope you understood the difference between current investment and long-term investment. Current investment, other examples can be your shares, debentures and all, because usually they have an active market, and also you can sell it within a year itself. Long-term investments usually will be your buildings and your land. Okay. Yes. So now that we have understood what are the types of investment, now let's move on to the next topic, which is your cost of investment. That is, in how will you determine what is the cost of an investment? Okay. Yes. So what I tell you is two inclusions or two bases are there. One, you have to take the acquisition cost of investment. That means at what cost you have purchased the investment. So that purchase cost will be called as your cost for investment. And as well as there is one more cost which will get included, which is your incidental cost. Incidental cost means any brokerage fees or duties which you have paid to get this investment, that will also be included in your cost of investment. For example, what you did is to buy a land or to buy a property, you paid a few fees and you paid a few duties. So those incidental costs which were important for you to incur so that you are able to purchase this land or building or property, then such cost will also be included in your cost of investment. In the case of shares, you pay brokerage, correct? So your acquisition cost and incidental cost both will come under your cost of investment. Hope that is clear. Now, here we were talking about acquisition cost and purchase cost. Let's see a few more points about it. Hope incidental cost is clear to you. Okay. So, purchase cost, what usually happens is that, usually what you do, if you want to get an investment, suppose if you want to get a building, okay, we'll take that you want to get a building. Okay, so to get that building, what you will do, you will pay money in return to them or cash in return to them, correct? So if you have paid your cash to get the building, then in such case the cash amount will be considered as your purchase cost. The cash amount will be considered as your purchase cost. Okay. Next, there is one more case where what you have done, instead of paying cash to get that building, you have given your company's share to them. You have given your shares to them, and for that shares, you have taken the building from them. Okay, you have purchased that building from them. Then in such case, if you have issued your shares or securities for purchasing a building or for purchasing your investment, then whatever the fair value of this company share is in the market, okay, issued, in that fair value you have to record it in your books as the cost of building. Suppose this shares, we have given 100 shares to them for a cost of 10 rupees, then the buildings of value in our books should be shown as building, which is our investment, and the value will be 100 shares into 10,000 rupees. 1,000 rupees. Okay. So this is how you will show it in building in your books. Next is, if suppose you have not given your, you have not given shares nor you have paid cash. What you have done this time is, you have given some other asset to them. Suppose you have given your plant and machinery, and in exchange of that you have got a building as your investment. Then in such case, what you have to do is, what will be the cost of buildings which will be recorded in the books? Then in such case, it will be either the fair value of the asset given up, that is your plant and machinery's fair value, or fair value of investment acquired, that means fair value of this building. Whichever is more clearly evident, or whichever fair value you are able to clearly find out, then that fair value will be recorded in our books, and that will be the value of your building or the building cost in your books or the purchase cost of building in your books. Okay, hope this is also clear. Then more example. So here what they are telling is virtual company is there. It has purchased 100 shares of Growth Limited. So first you have purchased, sorry, this is 1000 shares and not 100 shares. So 1000 shares at 100 rupees you have purchased, and you have paid a brokerage of 1% on it, and you have paid a brokerage of 1% on it. So what will be the cost? The cost will be purchase cost plus incidental cost. So it will be 1000 shares into 100 rupees actually into 101, because 1 rupee of 1% you have paid as brokerage also. So that cost will also be included here. So your cost will be 1,01,000. Then you have purchased another lot of 500 shares at 120 each, and here also you have paid a brokerage of 1%. So second lot you have purchased at 500 shares of 120 each, and you have paid a brokerage. So 101. So brokerage cost should also be added. So 60,600 will be your purchase cost of lot number 2. Then in June, the Growth Limited have issued bonus shares, 2 shares for every 3 held. So every 3 shares that you have held, they have given you 2 shares as bonus. Bonus means free shares. So it does not actually have a value to it. So what will be the cost of bonus issue? So bonus issue, how many shares will you get? So you have totally held 1500 shares. 1 minute. So you have totally held 1500 shares, and for every 3 shares held you have got 2 shares. That means 1000 shares you have got as bonus shares. And how much have you paid for it? Nothing. Okay, so nil will be the value for it. Okay, then they are telling that virtual company sold 1000 shares. Then finally they have sold 1000 shares at 110 per share. Okay, and they have paid a brokerage of 1%. So if you have sold something, you will get money in return. But for getting that money also, you have actually paid brokerage. So that brokerage value you have to less, so that you are able to find out how much net value you have received. After paying a brokerage of 1%, you have got 99% of the amount. So 99%. So we have totally got 1,08,900 from the sale value. So here what they are telling is we have to find out the profit or loss whatever we have got. Okay. So first we have to find out what will be the cost of the 2500 shares which is there in the book. So 1000 shares here, 500 shares here, and one more, and 1000 shares here. Okay. So what was the cost of it? The total cost of it was 1,61,600. Sale. Okay. So we sold 1000 shares only. So we have to find out the cost of 1000 shares here. So what will be the cost of 1000 shares here? So if 2500 shares are, so if the cost of 2500 shares is 1,61,000, the cost of 1000 shares, how much it will be? So it will be 1,61,000 divided by 2500 into 1000 shares. So the cost of 1000 shares will be 64,600. So we have sold it at 1,08,900 and the cost is only 64,600. So here we have got a profit of 44,250. 44,250. Okay. Hope you understood this sum. Now let's move on to our next concept, which is our valuation on balance sheet date. So how will you value your investments on balance sheet date? So here you have two types of investment. One is your current investment and then you have your long-term investment. Okay. So on balance sheet date, when you are valuing your current investment, that means here what it means is in your balance sheet at what value you have to show your current investment and your long-term investment. At what value you have to show it is what we are going to understand from this. Here current investment at what value you have to show is lower of cost or fair value. Lower of, so if you have a share, the cost you have got the share at 10 rupees, but today in the market the share is being sold at 50 rupees. So 10 rupees or 50 rupees, whichever is lower. So 10 rupees only you have to record it in the books. Okay. So it's the cost of purchase. At the cost that you purchase the shares, it was 2 lakh. But the fair value of those shares in the market today is 1,80,000. Then lower of these both. Then in such case, 1,80,000 will be your carrying amount in the books. As on balance sheet date, you will record it at 1,80,000. So you will show current assets at 1,80,000 in your balance sheet. Okay, hope you understood this here. Now here if you see, here you have got a loss. So earlier you had recorded this. Earlier you had recorded this in your balance sheet for 2 lakh rupees. So whenever you would have purchased this, you would have shown your current investment, not current asset, sorry, current investment at 2 lakh rupees. Now, but when you are revaluing it on the next balance sheet date, your value reduces from 2 lakh to 1,80,000 because you have to record it at either lower of cost or fair value. Now, when your value decreases here, you are certain to get a loss of 20,000, correct? So since the decline of value 20,000 is your loss, this what you have to do is any reduction that you have got, you can write it off in the P&L. So you can take it to the P&L and write it as 20,000 loss there. Okay, always remember this loss which you get, in case if there is any reduction in the value of the investment, you will get a loss. In such case, in that reduction, you should charge it only to the P&L and don't take it to the reserve. Remember this, you should not take it to the reserves. You have to charge it to the PL only. Okay, next long-term investment. Long-term investment, it is very simple. You have to record it at the cost only. Here, no fair value, nothing. You have to record the long-term investment at your cost only. Okay. But here there is one exception. Okay. If there is any permanent decline in value of the investment, then in such case, you can reduce the current asset. Or you can reduce the carrying amount. You can reduce the carrying amount accordingly. Suppose what happens is that there is one house that you have taken or a building that you have taken, and this building you keep it as long-term investment in your books. Now the building you purchased it at 2 crore rupees, but suddenly something happened after a year that building was started to be called as Booth Bangla. Now that building you have taken it to give it on rent. Now if the building is going to be called as your Booth Bangla or a place where the ghost resides, then in such case, what will happen in the market? Will anybody come and use this building or give you rent? The answer is no. So due to this, what happened is there has been a permanent decline in this value of building, that in the future, nobody will give you more than 1 crore for this building. So here you are recorded it at cost only. Every year you are showing it at 2 crore only. But here now something has happened, because of which there is a permanent decline in the value of investment. There is no chance in the future that the amount can increase from 1 crore to 2 crore. It is a permanent decline. Then in such case, in your books, now rather than showing it at 2 crore, you have to change it and show it at 1 crore now. So whatever the reduction is, you can reduce the carrying amount. Okay, and carrying amount accordingly in your books if it is a permanent decline. Remember that. Okay, and such reduction which is there. So here there is a reduction of 1 crore rupees. Here there is a reduction of 1 crore rupees, correct? So this reduction of 1 crore rupees, you have to charge it to the PNL. You have to charge it to the PL. Okay, hope you understood this concept. Okay, now here there are a few more points that I wanted to tell you. Here what they tell you is current investment. You can value the current investment on individual basis also or on category basis also. But you should not value it on a global basis. For example, if these are all your current investments, here you have equity shares, then you have gold, you have mutual funds, you have government securities. Take out mutual funds, okay? Let's take out mutual funds. Let's not keep it here. If you have equity shares, gold and government securities, and all of these three are your current investment. Now, when you are going to see cost or fair value, whichever is lower, you should not take the total value of equity shares, gold and government securities and see whether it is... So total value, suppose your in equity shares is 1 lakh, your gold is 2 lakh and your government security is 3 lakh. So here what you should do is, you should not take 1 lakh plus 2 lakh plus 3 lakh. So totally how much the cost is? 6 lakh. So 6 lakh is your cost. In that how much is the fair value of equity shares in the market? It is 1.5 lakh. Gold value is 50,000. And your government securities value is suppose 2 lakh. So what is the fair value in the market for all these three securities? It is 1,50,000 plus 50,000 plus 2 lakh. So it is 4 lakh. So 4 lakh or 6 lakh, whichever is lower, 4 lakh, you should not do like this. On a global basis, you should not see. Either you can see asset by asset wise or investment by investment wise. That is equity shares, you have to see cost or fair value, whichever is lower. Then you can see individual basis, that is gold also you can go and see separately, and then government securities you can see separately. Or else what happens is, here in under equity shares you might have 3 to 4 types of equity shares, each you can see on an individual basis, or since all of these fall under the same category of equity shares, you can see it category wise also. You can either do it on individual basis or category basis, but on a global basis you should not do. Here in the case of long term investments, you can only do it on an individual basis, on category basis or on global basis. Both you should not do. Okay, hope you understood this. So here we have a few examples. So here a few So here they have told that there is a long term investment and the cost of that long term investment is 2 lakh. in May, what has happened is due to company was incurring cash losses and declining market share, the investment will not be able to fetch you more than 20,000. You purchased it at a cost of 2 lakh, but due to the company was running into losses and the market share is declining, the investment value became 20,000. Now here, how will you show this in the financial statements? You have to tell. So usually long-term investment, you will show it at cost only. But here what has happened is facts of the given case clearly suggest you that this is a permanent decline. This is a permanent decline because here the company is running into losses, like Kingfisher only. It is running into losses. The market share is falling down. So now here you cannot see that the company might ever rise again. So it is like a permanent decline. So here you have to see cost of fair value, whichever is lower. So since it is a permanent decline, you can reduce your cost also or your carrying amount also. So in your books, you will show it at 20,000 rupees. You will show it at 20,000 rupees only. Okay. Here, remember one new term that you have to remember here is provision diminution. So what is provision for diminution is that it means if there is a loss or if there is a decline which is other than temporary decline, that means if there is a permanent decline in the long term asset, then for that we will create a provision for diminution. That is nothing but you will reduce your value, your carrying amount accordingly. Okay, hope you understood this. Next, what they are telling is, before going to this, we'll go into this sum. So here they are telling that you have made an investment of 600 lakhs in equity shares. 50% of it you have put in long term and the rest as temporary investment. That means 50% is long term. That is 300 lakhs is long term and the remaining 300 lakhs is temporary. That is your current investment. Okay. So the realizable value becomes 200 lakhs as Y limited. So 600 lakhs for whatever you have purchased for 600 lakhs. Now today the realizable value of the 600 lakhs investment has become 200 lakhs. That means 50%, 50% each means. So now the realizable value of long-term investment is also 100 lakhs only and the current investment is also 100 lakhs only. Okay. So here what has happened? So here if you see, here the current long-term investment value went from 300 lakh to 100 lakh and the current investment value, temporary investment or current investment value also went from 300 lakh to 100 lakh. Correct. So here 200 lakh each, there is a decline. There is a decline. For this you can create a provision of diminution. Okay. You can charge it to P&L. Here they are telling, since if, so now you have to see that whether this is a permanent decline or a temporary decline. This they are telling this is not temporary in nature. That means it's a permanent decline. That means in your books at what value you have to show? Then at 100 lakhs only you have to show because it is a permanent decline. Okay. Next, they have told that they have invested in the shares of another company at a cost of 2,50,000. They have purchased gold for 4 lakh and silver for 2 lakh. Market value are these. So you have got shares for 2,50,000, gold for 2 lakh and silver for 2 lakh. And today the market value of all of these is given here. Now you have to tell them whether at what value are you going to show it in your books. So, so if you see shares usually you do not keep it for long term. These are treated like current investments only. So shares, it will be cost or fair value whichever is lower because it is a current investment. So cost is 2,50,000, fair value is 2,25,000, whichever is lower means shares will be recorded at a value of 2,25,000 only. Okay. Then you have gold. Gold and silver usually you keep it for long term basis. Okay, it is a long term investment only. So gold and silver you should record it at their cost only. So the gold cost is 4 lakh and silver cost is 2 lakh. So you will record it at that amount. Hope you understood this illustration also. Okay. Yes. So I hope now the topic of valuation on balance sheet date is clear to you. Now let's move on to the next topic, which is reclassification. That means if you have a long-term investment, you classify it to current investments, or current investment, you classify it to long-term investment. Okay, that you have to see. So now here what we are going to do is, if you are converting your long-term investment into current investment, at what value will you record it in your books? You will record it in your books. This current investment, which has been now transferred from long-term investment, you have to record it in your books at the price, at a value of lower of original cost or carrying amount. original cost or carrying amount or your book value. That means originally at what cost you purchase a long-term investment, or today at what value the long-term investment is being shown in the book. Suppose you purchase a long-term investment for 2 lakh rupees. Today in your books it is shown at 1.5 lakh rupees. Then lower of these both at 1.5 lakh rupees only your current investment, this current long-term investment which is being transferred as or reclassified as current investment should be shown. So it should be shown at a value of 1,50,000. On the date of transfer, you have to see what is the current, carrying amount. Okay. Next, if current investment is being transferred as long-term investment, then you have to see lower of cost or fair value. So if the cost is lesser, then at cost you will record this long-term investment. If the fair value of the current investment is lesser, then at that value you will record the long-term investment. Hope you understood this. If long-term to current, then it is original cost or carrying amount, whichever is lower. If it is current to long-term, then it is cost or fair value, whichever is lower. Okay. Here now let's take an example. So they are telling you have current investments. You have purchased it for 20 lakh rupees. You want to reclassify it as a long-term investment, and the market value of the current investment is 25 lakh. Then you have to see then you have to see cost or fair value, whichever is lower. Cost was 20 lakh, fair value is 25 lakh. So here you can say market value as also your fair value. Okay. So 20 lakh or 25 lakh, whichever is lower. So it will be 20 lakh here. Okay. Next, you are converting your current investments into long-term investments. You purchased it for 15 lakh. The market value is 6.5 lakh. So again, cost or fair value, whichever is lower. So 6.5 lakh. Then finally, you have long-term investment, which you are going to reclassify as your current investment. And this you have to show it at what value you will show it. You will show it at either the original cost or carrying amount, whichever is lower. So the original cost was 18 lakh, carrying amount was 12 lakh, whichever is lower. So at 12 lakh rupees only you will show your current investments in the book now. Okay. Hope you understood this. Here let me give you a quick example on what is the difference between market value and fair value. So market value is the value what is existing in the market. Okay, correct. In market, if you're going to sell it today, what value you're going to fetch from it is known as market value. Whereas fair value is the value where two knowledgeable buyers and sellers come together and decide upon a value for that product or for that investment. So that is known as fair value. Okay. Yes. So here there is one more example. So you have same thing only. You can go through this example by yourself. Here it is actually you have to tell them whether you know this is right or wrong. Okay. So here they are telling current investments are there and current investments are valued at 60 lakh rupees being the cost of acquisition. So the purchase cost is 60 lakh rupees. Fair value as on balance sheet date is 48 lakh rupees. Fair value as on balance sheet date is 48 lakh rupees. So at what value will you record this 60 lakh or 48 lakh, whichever is lower. So 48 lakh. Then you have current investments. Cost of it is 86 lakh rupees. Fair market value is 90 lakh rupees. Here what happens is due to insufficiency of profits from operation, the company would like to recognize a profit on these investments for improving its financial statement. So here what they are telling is current investment is there. Here 86 lakh is your cost. Fair value is 90 lakh rupees. So what will you record it this in your books? Fair value or cost, whichever is low. So 86 lakh only you have to record it in your books. But here what they are telling is since fair value is higher, can we record the profit in our books? The answer is no. You have to always record it on whatever price is lower only. Okay. So 86 lakh only. So profit you cannot record it in your books. Finally, the company is saying a company has a current investment. The policy of determining the carrying amount of current investment is as follows. Whether you have to tell now the policy is right or not. Quoted securities at lower of cost or market price. Quoted means listed securities. Listed securities means the securities which can be sold in the market. So for that you can do lower of cost or market value. Correct. Okay. Yes, this is right. Because it is a current investment, it will be lower of cost or fair value only. Next, uncoded investments at cost. Uncoded investments means co-investments which cannot be sold in the market. If you cannot sell it in the market, even if it is a current investment, you will not have a market value for it. So here the question of market value is itself doesn't come. So you have to record it at cost only. So this is also correct only. Okay. Yes. So now one final topic where they say when you compulsorily acquire shares of cooperative society. So what they tell you is there is a concept where they tell you that if you have to become a member of cooperative society, then in such case you have to acquire the shares of cooperative society. Then only you can become a member in cooperative society. Correct. So in such case, if you acquire a property there, you have to become a member of cooperative society. Okay. So to become a member of cooperative society, then you have to acquire shares also. So the cost of property which you are acquiring, to that you have to add the cost of purchasing shares also, and that will be a total cost in the book. The total cost of property will be the cost of property plus the cost of purchasing shares which you have acquired to become a member of cooperative society. So both of these you will get as the total carrying amount of the property. Okay. This is only the case when cooperative society comes. So yes guys, so I have covered all the questions possible and also all the concepts of AS 13. I hope you found this video helpful. In case if you did, please make sure to like, share and also subscribe to the channel and share it with your friends too, and leave your comment or your feedback down in the comment section below. Thank you so much for watching guys. Meet you in the next video. Thank you.